Hey guys, welcome back to another video. Today I'm here to talk about 5 stocks that I think buying right now are honestly better than buying Nvidia. Yes, I said it. I think these stocks are better than buying Nvidia before it had its massive run up. If you guys do enjoy this video, be sure to smash that like button. Also subscribe to the channel. I really appreciate it. It helps me out a lot. Very close to 600 subscribers. Appreciate you guys. Let's get right into it. So, as you can see today, great day in the portfolio. AMD is running. We are over 28,000. This brings our weekly gain to about 18%. Very happy with that. But the first stock that we're here to talk about today is ticker symbol GOOG, ticker symbol GOOGL. It does not matter which Google you buy. I have some of both. This stock is very attractively priced. Excuse me. I'm not going to take that long getting into every single one of these stocks because there's 5 of them. I don't want to take up too much of your time, but I do want to, actually show you guys what they're about. So this stock is almost $3 trillion market cap, huge company. Their PE ratio is 26, very low compared to other stocks in the space. Like if we look at Microsoft, their PE ratio is not 26, it's 38. If we look at Apple, theirs is, high 30s as well, not 26, 38.99. So this straight off the bat tells me that Google's undervalued, especially because, Google's PE ratio is still low. And look at their run up in the past year, they're up 50%. Year to date, they're up 28%. Past 5 years, they're up 235%, and their PE ratio is still low. That means that this is still a great company that there's time to get in on. They also pay a dividend of 0.33%, not crazy. But if you guys do like dividends, then that's there. And then they're also beating earnings every single quarter. So Google is a very attractively priced company. I think that they're a great stock to invest into. If we look at their earnings right here, they're attractively priced and they're not doing bad. They're up 14% on their revenues year over year. We see their total costs and expenses, not worried about that. But basically their revenues up 14%. I really like to see that. Their revenues and operating income are both up, which is, you want those to go up simultaneously, so that's great. And then their cost of revenues also up a teeny bit, but up less than their revenue, so they're still making money. We see the sectors that they are making money in are actually the sectors that they're growing. I'm very happy. Google search is growing 12% year over year. That's their main, that's how they're making most of their money, the majority of their chunk. We see that is actually, that went from 48 to 54. So that was a 12% increase for them. We see the YouTube ads, 13% increase. And then subscriptions, platforms, and devices. This is things like YouTube TV, things of that nature. So YouTube TV is something that I actually really like. I think that I have it and it's a very good deal. A lot of people are going to start buying it, I think. So that's very good. And the Google Network down 1%. Not worried about that. Growth rate on all these other ones look great. Operating margin 40%. Love to see it. Google Cloud revenues. So this is a big thing. This is their cloud computing. They're renting their services to other people. This is big. This is up 32%. So this isn't a really big part of their business right now. Only you see this is in millions, but 13,000, not a huge portion because you look at their revenue right here. This, I think they tied it in with Google search and other. But if we look at their total revenue, we see that that's, 96. So this is about 15%. I don't think it's going to be like that for long. I think this is really going to, this is going to start to skyrocket pretty soon here as we look at their, Google Cloud and more people are getting into AI and renting infrastructure and things of that nature. Google Cloud is gaining on AWS. AWS is Amazon's main thing, but Google Cloud, they're right there. They're very close. They're very close to, where Amazon is, where Amazon wants to be. Google's right there. So I think that Google investing in it just for Google Cloud makes sense. That's a big part of their business that's going to do very well. Their capital expenditures are rising very, very fast. So this is a common theme in a lot of these tech stocks. They're just spending more and more on AI every single quarter, trying to catch up with the next company. Google here can afford to do it. If we look at their free cash flow, it is going down. It is going down, but also I'm not too worried about it. This is happening. You can check every single Mag 7 company. This is happening to all of them. So if one of them goes down, most likely all of them are going to go down. So I think out of the Mag 7, Google is the one I would invest in right now. It is just very attractively priced, and especially for what they have to offer. Excuse me. There's a lot of things that they have to offer that you don't even know about. Waymo. Do you guys know about Waymo? Waymo is autonomous rideshare service. It's like Uber, except there's no driver. This is expanding very rapidly over in San Francisco. There's some in Texas. There's also some in Los Angeles and Phoenix. This is expanding very fast. And once they have Waymos in every single city, Uber's going to be done. Uber's going to be gone. Waymos are always, there's one available because there's people, I mean, there's always Waymos out. And then they're cheaper than Uber. They can undercut every single price Uber has because they don't have drivers. They own their vehicle outright, but they literally have no expense besides charging the vehicle with electricity, which is pennies on the dollar. So I think that's going to be the biggest part of Google's business pretty soon here. I think that is going to bring them the most revenue over the next decade. I think that alone could be a $5 trillion market with their market cap of $3 trillion right now. I think if you add 5 trillion onto this, because I think it would increase revenues maybe $300 billion. What are they at right now? Just about $1 billion. So 10 billion. I like what I'm seeing. So Google, very good first stock to get into. I think this is very attractively priced. And also it's a safe bet. You buy a lot of Google, you're probably going to have a lot of Google in the next 10 years. It's not a stock that's just going to go away all of a sudden. It's one of those ones where you can feel pretty confident buying a lot of it as your first stock. Maybe not with these other ones if you're a new investor. So the next stock we're here to get into, also one of my favorites, is Cheesecake Factory. I have a lot of videos on Cheesecake Factory. This stock has actually taken a little bit of a downturn since the last time I made videos on it. So this one's down 17% right now. This is the perfect time to buy Cheesecake Factory. Right after the video ends, I promise you guys I'm going to go buy, $200, $300 worth of Cheesecake Factory. This is, this is a stock that I can confidently say is going to be worth $100 plus in the next 3 to 7 years. And that return is a compounding annual growth rate of more than 10%, which is all I'm looking to do is beat the S&P 500. If I can do that anywhere, I'm happy. So this one's going to be a very expensive stock. They're only 3% of my portfolio right now. After this investment today, they might be 4%. I'm not sure how much that'll make them a part of my portfolio. But this company is relatively small, $2.65 billion market cap. Their PE ratio is insanely low, especially for what this company is bringing in. I mean, the growth opportunity in Cheesecake Factory, that's the thing that people don't understand about Cheesecake Factory as well, is it's not Cheesecake Factory. It's not. It's North Italia and Flower Child and Fox Restaurant Concepts. We'll get into that in their earnings presentation, but it's not Cheesecake Factory. Let's just say that. So the 2% dividend yield is also nice. This is a dividend company. If you are into investing into dividend stocks, me personally, not my favorite. I'm more of a growth investor, but at the same time, I do enjoy dividend companies. So Cheesecake Factory is also like a great time to buy it. Usually I don't suggest timing stocks, but I think that, I don't think it's going to drop much more than this, especially when their earnings come out and they, once the debt starts, this company is very debt heavy, That's one of the things that makes it not as attractive is that it's very debt heavy, but they are opening a lot of new restaurants. So once those rates get cut even more and that debt is less and less, and it's going to go up. So the investor presentation, that was enough talking about that. We see Cheesecake Factory has been around since the beginning of time, 1972. All right, that's not that long. But 216 Cheesecake Factory locations, they're everywhere. 34 international locations. You see they're in China, Thailand, Mexico. They're everywhere. North Italia locations, there's 46, 42 Flower Child locations, and 52 Fox Restaurant locations. So there's a lot of different locations for this company. And they're spread across, you can see right now, if you do the math, there's almost as many non-Cheesecake Factory locations as there is Cheesecake Factory locations. So, we'll get into that. But also they have a market cap that's lower than their revenue, which is interesting. This company isn't making a lot of, they're not, they don't have growth rates of 25% a year like a lot of these tech companies do, but at the same time, they're not doing nothing either. So not important right there. Let's go down to where they talk about the Cheesecake Factory. This is interesting. Moderate average check of $31. That's good. I like to see that. And then the highest unit volume in the industry. Good to see. But this is what we're worried about. North Italia. North Italia is it's another restaurant owned by Cheesecake Factory. It is a filling white space for an on-trend contemporary Italian offering. This is Italian food. This is not really that important, but they do have an average check of $30 for lunch and mid-40s for dinner. So if we go back to right here, you can see $30 for lunch, mid-40s for dinner. That probably places you around this $36 average check range. North Italia, so this is what's important right here. They have potential for 200 domestic locations over time. Yes, 200. They're at 46 right now, so they're a fourth of the way there, but they're still expanding rapidly and they're targeting 20% clip on this average annual unit growth. And there is an attractive return profile and sales growth. This is very true. North Italia is looking to be very good. Very good. So their comp sales, we see that this is, this isn't good. They're down 1% on comp sales, but that is because they're opening so many of these new restaurants. I mean, once they have 100 of these restaurants and they've been around for a few years, I think that those last 100 that they build, they're going to be a piece of cake. And then those last 100, they're going to build at 20%. They're going to be building 20 a year. Okay, so this is a very quickly expanding project. If you guys know how compound interest works, building something at 20% unit growth, starting at 46, they're going to be at 200 pretty soon. Okay, so that's not something to worry about. They're going to build around 10 locations. They're going to be at 60, then they're going to build 12, then they're going to be at 72, and then so on and so forth. And they're going to build probably 15. There's a lot of growth for North Italia. This is also just a great restaurant. At the end of the day, that's what you want to invest in, is something that people are gonna buy, people want. They have a great thing going for them with their branding, their interior. The only thing is that this company is taking out money and borrowing money against North Italia to lease these locations or buy these locations and then also start this brand. So that's the only thing. But also the return profile, like it says here, it's very attractive, and at the same time, I'm not worried. It looks like from the returns, money's gonna come back pretty quick. So the next one, which is more important than North Italia, if you guys aren't listening, listen right now. Flower Child, healthy food for a happy world, on a simple and satisfying mission to spread positively delicious vibes and healthy food. Very, very good mission, very good branding, very good idea to stand behind, especially in the world right now where health, I think, is going to become, it is, I mean, health is the most important thing, but as time goes on, health is going to become more and more important. You see it right now. 50 years ago, just 50 years, just 20 years ago, people didn't know Doritos were bad for you. People didn't know soda was bad for you. People didn't know cigarettes were bad for you 50 years ago. And now, I mean, you see how fast things are going. I mean, healthy food is gonna, I mean, it is the next big thing. It already is, but it's gonna be even bigger. So they have potential for 700 domestic locations over time. 700 domestic locations. That's a lot of locations. I mean, guys, even if these 700 locations bring in $1,000 profit a year, let's say they're just doing horrible and they bring in $1,000 a year profit. That's $700,000 profit a year for a company that's doing a revenue of 2.65 billion. That would, I mean, even if these companies did that, then this company would skyrocket. It would be making way more money than it is right now. So a differentiated concept in the growing fast casual dining segment. There's 42 locations right now in 15 states. They're also targeting 20% average annual unit growth. It's a healthy, balanced dining experience with organic, gluten-free, and vegan dishes. Another thing, vegan people, gluten-free, vegetarian, they're willing to pay more for, oh, we don't have, chicken, or we have burgers, but we also have veggie burgers, but they're $8 more. Okay, that's fine. I'll take it. That's a lot of money. Upcharging all those meals, I really like to see that. So that's something that, the health consumer demographic is not going to be worried about. They're not going to care. Attractive consumer demographic, like it says right there. I just talked about that. Significant off-premise volume, averaging 50% of sales, so they don't have to have this restaurant jam-packed with servers, bussers. The manager doesn't have to be there all the time. This is something that, a lot of people are just going to be in the kitchen actually working all the time, and I mean, that's amazing. They don't have to pay a lot of money for waiters and hosts to wait around and sit people when it's not that important. There's also a separate takeout area for third-party delivery and takeout businesses. Love to see that. Also, the Fox restaurant concepts, which is just as important as the other restaurants. So there's 52 locations right now, doing $300 million a year in revenue. They're growing these at 10 to 15%. We'll see that later. I've already gone through this, but they're growing these at 10 to 15%. If they grow those locations at what they're saying, that's around 5 to 7 locations, 5 to 8 locations a year maybe. I mean, in the next 10 years, you're going to see the revenue double. You're going to see a lot of these actually. So what this is is incubation periods for big companies. These are their list of companies. The Cheesecake Factory is worldwide. That's what's making them their money. That's, great. Cheesecake Factory, it's a good restaurant, it's a good business. The national expansion opportunities are North Italia and Flower Child. These are why you're investing in Cheesecake Factory, not because of Cheesecake Factory. It's because of North Italia and Flower Child. That's why you're buying this company. Testing growth, Culinary Dropout, Blanco, and the Henry. These three restaurants they're testing growth with. They've seen, okay, these restaurants work in these areas. We're going to get some new ones in these areas, and we're going to see how those work. These restaurants could also have potential for 200, 700, 500 locations over time. It's just all a time thing with Cheesecake Factory. And because they have the financial backing to invest into every single one of these companies, I don't see anything stopping this company, especially with all of these, great restaurants and a lot of these, excuse me, a lot of these restaurants that they're also the cuisine that they're offering is just very popular. I'm accelerating unit growth, as many as 25 new units in 2025. Love to see that. We see the Cheesecake Factory added 2 locations. Again, I don't really care. North Italia added 4 locations. I do care about that. That's great. Flower Child added 6 locations. Also amazing. Culinary Dropout 2 locations. So this is one that they're actually testing growth on. And then also the Blanco and the Henry. Two that they're testing growth on that they're building new locations for every year. I love to see that. Okay. Financial performance. We look at this, we see that it's good. It's good. It's not, this is still the early stages for this company. Excuse me. This is still the early stages. So, excuse me, needed some water, but this is still very early stages for this company. They're up a little bit year over year, but North Italia is down a little bit. They're expanding, very aggressively. I'm not worried about that. And then Fox Restaurant Concepts, who are also expanding aggressively, are up 2%. Not, I like to see that. I don't need that, but I like to see that. Total revenue is from Q2 2025, almost $1 billion. So it's looking like, if they keep this up, they'll be at $4 billion revenue this year. That's pretty good. 2025 underlying key assumptions, their consolidated sales, they're thinking they're going to do 3.76 billion. Net income margin, probably 4.9%. So not amazing, but that's what it is in these restaurant companies. It's around 5% profit what you're making. Not amazing. But that's why you have to have 700 locations to make money. They know that. Cheesecake Factory's been around forever and they know what they're doing. This is, another picture. So Cheesecake Factory is actually targeting annual unit growth of 2 to 3%. And with 200 locations, that's about 4 to 6 restaurants a year, which I think is good. I think that's attractive. I think that's good for Cheesecake Factory. And then you guys know 20%, 20%, and then 10 to 15. Revenue growth potential. This is only the beginning. Okay. So the market potential for all three of these are the only thing that's accounted for in this revenue growth. Not even the Culinary Dropout, the Henry and Blanco. Those aren't even accounted for. Those are going to make as much money as North Italia and Flower Child, if I had to guess. Conservatively, one of these three is going to be as big as North Italia. So you can add, this is going to be a $10 billion revenue company. So 5 billion revenue potential growth. This is going to be a 10 billion revenue company. More of that is going to be profit because they're doing these, small boutique brands. The Flower Child does not cost as much to maintain as the Cheesecake Factory. It just doesn't. You have a business model like that, it's just not as expensive. North Italia as well, we see that this is, also going to add a lot to their revenue growth, but, Flower Child is the main one right here. So I'm very, very happy to see that Flower Child is very big on that. And not much more important things in this investor presentation. We see their free cash flow is, this is a cash cow, this company. They're giving that, they give a dividend, so they have to be, but they do very well. Also net income, we see that this is 54,000. So that's good. That's good to say the least, but I think that this company can be at a lot higher. So very happy to see this for this company. Let's get into the next one. So Cheesecake Factory, very attractive buy right now. I think they were a good buy when they were, up here at their, I think 52-week high of $69.70. They were a good buy at that time. Now they're 53. Now they're even a better buy. So I really like Cheesecake Factory right here. I think that buying right now is the best time. Honestly, that's why I'm putting in $200, $300. It's a very attractive time to buy the company. A lot of people don't even know what this company does. So getting in right now, I think, is the best thing you can do for yourself. So on to the next stock. That stock is going to be the very powerful Shopify. So Shopify is a company that, yes, they're on a tear. Okay. Shopify is up year to date. They're up 55% in the past year. They're up 106%, but I don't see this stopping. I mean, they're not, I mean, they just passed, actually, let me rephrase. They just passed all-time highs. This company is looking, honestly, just amazing. They have a $200 billion market cap. This is going to be a $1 trillion company. I'm very confident that you're going to 5x your money as e-commerce becomes more and more popular. It already is. I mean, one of the most popular things. E-commerce is how a lot of young people are making a lot of money. I've made a good amount of money with e-commerce over the years. I've always used Shopify. Shopify is the best thing, I think, in my opinion, for doing e-commerce. We look at their earnings; they're beating every single quarter. This is great. This is a company that you're gonna want to get into. Their P ratio is very high right now. I don't think that's their forward P. I think that's just not really. I'm not worried about it. Okay, I mean this company deserves to have a high P ratio for sure. But yeah, I mean, look at the growth on this company, just insane. Okay, so let's get into the investor presentation here. So we can see that Shopify, great company, they have $2.4 billion in revenue. This is up 27%, a growth rate of 27%. I mean, that's insane. $1.2 trillion of global commerce since Shopify's inception. Another great, a lot of great stats right here. Shopify knows what they're doing on this investor presentation. They help accelerate the power of entrepreneurship and merchant success, leading platform for entrepreneurship, increasingly all of commerce, and our merchants do better with Shopify. This is very true. There's a lot of things that have been seen. I mean, a lot of brands that have joined Shopify that have started to do better. You see, these are huge brands. Mr. Beast, if you guys are watching me right now, you know Mr. Beast on YouTube. Fashion Nova, another big fashion company, Gymshark, humongous. And then they just added Dickies, Life is Good, Jansport, JD. These are huge brands. Nestle. These are huge brands that are using Shopify. So it's easy to say that Shopify knows what they're doing. Shopify is obviously, I mean, a $200 billion company. There's a lot of money to be made in Shopify. And we see that they actually just added Shop Pay, which is another thing that they're adding to their ecosystem of products. That's what these great companies do. Apple has Apple Pay, Apple TV, all of these ecosystem type of things, for lack of better words. It's just a lot of things that make you stay there. Shopify is doing the same thing. They have Shop Pay now. You can buy stuff with Shopify. Revenue cohorts get stronger over time. Also love to see that. It's not even their main revenue. I mean, just insane, honestly. And then their core market of e-commerce has so much runway. So this is what really entices me about this company, is that it's very hard to expand internationally. A lot of companies try to do it. A lot of big companies try to expand internationally, and they do it, but they do it at a very slow clip. So Shopify is in the same boat. It's a little bit slower than America. I mean, obviously. But this one isn't. They took 2%. You see Latin America right here was at 2%. Now it's at 11. Okay. They started at 6% in America, now it's at 16. So there's the thing with Shopify is they don't have to go and build locations overseas. They're just online. They just maybe have to pay a little bit more in advertising, not even that. People are gonna just become hip to it. And when I mean, this is, as I've been saying on my channel, if you guys watch a lot of my videos, international is the opportunity right now. So every stock that's expanding internationally, I think the ones that get that international positioning first are going to be the ones that are winners over the next 10, 20, 30 years, the time frame that I'm looking to invest. Because international, I mean, there's economies that are growing just as fast as the US. Their populations are growing faster, so there's more consumers in their economy. I mean, there's just a lot of things that are happening internationally that the US does a lot of things better than other countries, but at the same time there's other countries catching up for sure. So we see that they're actually, I mean, look at the way that they're growing. 2015 to 2020 they 3x'd their market, and in 3 years they more than 3x'd it. They 5x'd it. They more than 5x'd it. That's insane. So I just can't imagine what the 2026 numbers are going to look like if these were, 3 years apart. I'm happy. With only 2% penetration of our opportunity in the geographies that we currently serve. So their global revenue is 1% penetrated of what they want to do. This is 1% of the company. If this is true, then there's room for 99% growth in this company. Okay. So that would mean that the stock price goes up like 99 times. They're saying that this is this is one of 100 of what the company's worth or what it's going to do eventually. So I'd like to see that. I'd like to see that. They're helping their merchants grow their business, which is what you want to do if you're providing this service. You don't want to, have merchants that aren't growing their business. This is why people are coming back to Shopify. They have the reoccurring revenue of people paying that monthly fee to host a website on Shopify. It just makes it really easy. I love Shopify. You always want to invest in things that you also personally believe in and you personally use, and Shopify is one of those things that I personally use, I personally believe in. So their monthly recurring revenue continues to grow. We see this is 27% on a 5-year compounding annual growth rate. It is at 182 million. Their monthly recurring revenue. I mean, gosh, that's insane. They reached their lowest quarterly operating expenses as a percentage of revenue at the end of 2024. So your revenue is the highest it's ever been, and your operating expenses are the lowest. That's a good combo. That's a good combo. That's the thing with Shopify too. They can make their operating expenses virtually nothing. I mean, not nothing, but just really, really low. Shopify doesn't have a lot of things to, worry about when it comes to paying for things. I mean, yes, virtual things, but at the same time, none of these are like, they're not leasing a bunch of buildings across the US. They're not locked in on these 30-year leases. They just have things that they might need to buy initially with a little bit of maintenance cost, but a lot of them they can just pay off. So I really like that as well. Subscription solutions revenue continue to increase year over year, 21% increase year over year. Wow. I mean, this is a great slideshow as well. If you guys are, want to look at investor slideshows, this is as good as it gets. Okay. There's a lot of good ones, but I mean, like you saw the other two, Google's is not that good for Google. I mean, Google's a humongous company, but their slideshow, I could make a better slideshow. Cheesecake Factory's is pretty good, but this one's very good. Okay. At a glance, $588 million offline revenue, not even from their stores. I mean, wow. And then they're, excuse me, they're also doing 15 countries of, POS hardware with integrated payments. So I use Square. I don't know about Shopify's integrated payments. I'd be very interested to check that out. So yeah, I mean, a lot of room for growth in Shopify, but they also have a lot of growth already. So Shopify is that company that you can be happy to buy right now. I think that you just can't be scared. You're not trying to time the market, okay? You're not trying to time the market when it comes to Shopify. This is an expensive stock, yes. This is an expensive stock. Do you want to buy an expensive stock? Maybe not, but I would if it's Shopify. That's the thing. There's always companies that can break some rules. So my investing thesis is usually, okay, I'm going to buy a cheap stock. But I mean, Shopify is just so good of a company with growth rates that are sustainable and not, they're not paying a bunch for these growth rates. You saw their profit margin is just insane. So, I mean, this is a company that I'd be happy investing in, even at all-time highs. Because you look at these companies, if you didn't invest in Shopify right here, you were like, oh, it's too expensive. When it was $116, you would have missed out when it was $166. So there's just a lot of, these companies that are great break all-time highs all the time. Like, for example, a company in the Mag 7, Google, if we look at their 5-year chart, if you thought Google was too expensive right here, oh, they're at an all-time high, they're at 150, I can't invest into Google. Now they're at 245, so you missed out on about a 66% gain. Just saying. So the next stock that we have here to talk about, Shopify, great stock. I'm a little sick, guys, so sorry if I'm sound under the weather a little bit, but still want to make this video for you guys. Elf is the next stock. This is one that is my second biggest holding. I very much believe in Elf. I like Elf a lot too because they're not in the tech space. So when, the tech space has a bad day, I'm not down 20% in my portfolio. I have 20% of my portfolio in Elf because I like to diversify my portfolio. Obviously, I do have a large holding, which we'll talk about later. But Elf is definitely a large holding for me. This is about 20% of my portfolio, my second largest holding. I very much like Elf because of this reason. They're very attractively priced, Elf, at the same time. So this is a company that's not even at their all-time high. Their all-time high was $210. I think it was even more, 200, yeah, 210, 217, somewhere around there between 210, 220. This is a company that's just getting back on their feet after the tariffs kind of messed them up, okay? There's no way to sugarcoat that. This company went below $50. Their 52-week low is $49.40. Okay, their 52-week high is $150. So right around here, right around what they're doing right now. And this is a company I'm not worried about investing at their 52-week high. This company is $8 billion market cap. It's not huge. It's not humongous. It's decently sized, and they have a PE ratio of 80 right now. That's also not real. But the dividend yield, they don't pay a dividend. This is a growth company, which I very much like to see. And their investor presentation is the bones, the meat and bones of this company. So they're up 9% net sales. Love to see that. There's 26 consecutive quarters of net sales growth and market share gains. There's one company in the Mag 7 that has done this, and it's NVIDIA. Google hasn't done this. Amazon hasn't done this. Tesla hasn't done this. Microsoft hasn't done this. No other of the Mag 7 companies have done this besides NVIDIA. So you're investing in, almost NVIDIA. Because cosmetic brands, or, it was either one of these. I actually got a little confused. But cosmetic brands, out of 988 to gain market share, they're one of one for 26 consecutive quarters. This is still a relatively young company as well. We see that they actually were founded in 2004, but they've only been public, I think, since 2016. So they've been around for maybe 10 years. So this is still a young company, especially in the makeup space. That's a hard one to break into. Quarter one progress with cosmetics, we see they're 15% today, 13%. I love to see that. Number 2 in dollar per unit share, and then number 1 in unit share. This is a very popular company, okay? This is one that moves a lot of product because they sell for the cheapest price. This company is known for their value. It's, they have value at the cheap price. So they'll sell their makeup for an average of $6.50. The top brands, $9.50, and then the prestige brands over $20. So Elf is attracting everyone. They're attracting people that don't have that much money, people that have a lot of money that enjoy their products. But these companies are not attracting people that don't have a lot of money, which is a lot of the U.S. right now. So, honestly, a lot of the time, and even when the U.S. does get more money, when the economy is booming, people still don't want to spend a lot of money on makeup. Having a cheap makeup option that's also viable, it's pretty good. And then they're also increasing their price by $1, okay, on August 1st. So this is happening next year, but when this happens, you're going to see the company's price. The balance sheet is going to be insane. The earnings reports, increasing every product by $1 is going to really, with the amount of products that they move, that dollar increase is going to be insane. This is going to add a lot to the top line. So I definitely get in before that. If anything, just maybe watch this stock until August of next year, but people might not even remember that that's happening in August of next year, so they're going to see the earnings report and be astonished, I think. So I that's going to really bring up the revenues and the profits a lot, especially the profits. So they're in Walmart, they're in Target, they're in drugstores, grocery stores, and they just got into Dollar General. We see they're in 80% of the Dollar General stores, over 20,000 people, and these are very good metrics. 60% dollar growth from shoppers new to Dollar General, and then 53% of shoppers are new to Elf. So they're expanding their customer base. And this just isn't a Dollar General. People that go to Dollar General also go to Target. They also go to Walmart. They also shop online. So there's a lot of places to buy Elf that isn't at Dollar General. And now that these people are new to it, I think that conservatively, 20% of these 53% of new shoppers new to Elf are return customers that are going to buy Elf all the time. That's very conservatively. I think that Elf has a product where it could be 50% return customers, 60, 70, somewhere around there. So it's very attractive. So number 1 cosmetics product on elfproducts.com is this. Versus prestige brands, they sell theirs for $48. Elf sells theirs for $18, and it does the same damn thing. People are happy with it. Disruptive marketing engine, we see Elf-ing Entertaining. I don't want to get into that. I think that Elf does have good marketing. They do target the right people, the right places. TikTok, Instagram. This is very important. They do have their cosmetics. They also have their skincare. This is very important. I talk about this every time I talk about Elf, because their skincare is something that everyone can use. Okay, makeup is used by everyone, but not a lot of guys use makeup. It's mostly a female based, customer base, which you see brands like Alani Nu that, only focus on female based customers, but as they're expanding into the skincare space, which is primarily female, but not really. I mean, it's, 50-50 male female. This is a space that has a lot of room for growth over the next couple of years and decades and, until the end of time, honestly. So, I'm very happy with what Elf is doing with this. I think that this is something that's going to drive a lot of revenue, a lot of profit into their business, to say the least. I like that. So okay, so Elf looks very good on that front. A lot of other products that they sell this product for $16. Prestige brand sell it for 185. Okay, and Elf's profit margins are pretty good. So those prestige brands are probably making a lot of money when they do make a sale, but they're not making many sales. Elf is also expanding internationally. Love to see that as well. They're in over 1,200 stores, and I don't even know how to pronounce that. They're the number one beauty retailer. You see in Europe here, overseas, they're number one and number two. Love to see that as well. They're expanding. Elf is expanding into these big, Sephora's actually over in these European countries. Love to see that. I mean, this once they get that international footprint too, people order online from Elf. They can order from anywhere. International penetration, just over 6 years, it doubled. Okay, so they're at 10% to 20%, 28 million to 266 million. This is just over 6 years. Over the next 6 years, if they grow at the same clip, we're going to see 40%. This is going to be 500 million. I think that's very, very doable. So Rode is also another thing that they're doing, another brand. They have $212 million in net sales, so this is also a great thing. I mean, Elf just looks amazing right now. I mean, the numbers are looking very nice. They have $3 billion in net sales, 1.3 billion in 2025. Or no, this is the future. They have 1.3 billion in 2025. I was about to say that's a lot. But in the future, they're expecting 3 billion with 2X Cosmetics, which makes sense. Their cosmetics are growing very fast. 2X Skincare makes a lot of sense. And then 2X International, which we just saw, is going to happen. So very, very much into Elf. I think this is a great company to invest into. They also have $170 million of cash on hand. If anything happens, they're going to be okay. $20 million of free cash flow, $600 million term loan, $200 million, and 2.6 million shares of common stock. Elf looking very attractive right here. They're also, this is a big thing that people were worried about, tariffs. So 170% between April 9th and May 13th. I'm not even sure what that means. But their tariffs, they did actually find a way around that, so I'm very happy with that. Tariff playbook, pricing, supply chain optimization, and business diversification. Tariffs aren't going to be around forever. Also, they've kind of subsided. So I'm not worried about that at all, honestly. Very good company. Elf right now, very attractive, very long investor presentation. You guys just got a sneak peek at the next stock. But yeah, I mean, Elf is a company that I'd very much suggest investing in right now. It's my second holding. Second to AMD. This company is on a tear right now. I'm up 120% on AMD. This is my largest holding. This is 43, almost 44% of my portfolio. I own it for an average cost of $107, and the only regret that I have is that I didn't buy more. AMD over the past week is up 47% as a company. They were trading for $160. Now they're $235. Over the past month, they're at 50. Past 3 months, they're up 71. And then year to date, they're up 92. Okay. So this company was trading for $78 at one point. If you got in for that, you 4x your money. I didn't get a lot of $78, sadly. Probably should have took out a loan, a second mortgage on my house. I didn't know that AMD was going to do this. I knew they were going to go up, but oh my gosh. So their market cap is $381 billion, and the reason for them going up, not tell you guys, is because they actually struck a deal with OpenAI. ChatGPT is going to buy a lot of their chips. Okay, I made a video about it the other day. You guys should go watch that if you haven't. But ChatGPT, OpenAI, is going to buy a lot of AMD's chips. Okay, it's going to boost their revenue by a very good amount, very healthy amount. So AMD is looking very, very attractive right now because that's guaranteed profit and revenue that's being increased. So if we look at AMD's financial results, their second quarter, this is their investor slideshow presentation. We see their data center, client and gaming, and embedded are their three large growth opportunities. We see that their revenue in quarter two of 2025, record second quarter revenue of $7.7 billion, increased 32% year over year. the deal that they have with OpenAI is going to make them at least $10 billion. Okay, so that's going to just add on to the top line, and that's at least, and it's probably going to be closer to 50. So I think their revenues are going to be doubled over the next 5 years, and that's conservative. I think their revenues are going to be doubled. Their gross margins are down a little bit. Not worried about that. This company is expanding very heavily. Operating income, same thing. Their P&L on their GAAP report is actually pretty good. They're up 3% on revenue. Gross profit, they're down 18. Not too worried about that as they're expanding, like I said. And then operating expenses up. That's from the expansion. We see the summary of their P&L quarter two non-GAAP is actually pretty much the same thing. So not really worried about those. I wanted to check out this. So this is their data center. These are how they're making their revenue. So this did $3.2 billion. The data center segment is going to make them, like I said, over $50 billion in the next 5 years, I think. So this is the company's going to go up a lot. I mean, it's already up a lot. This is going to be $1,000 stock, I think. I honestly think that that's a lot of money for me if it does do that, and I think that it can also be a lot of money for you if you get in right now. So I think the AMD is very attractive right here. Their data center segment is the one that's going to benefit from this. This is up 14% year over year. Amazing. Operating margin not looking amazing, but I think that's because you see their inventory and related charges associated with U.S. export restrictions. They're going to get on top of this pretty soon. Okay, so their revenue is looking great, but their client and gaming segment, this is the one that people were worried about. I was worried about it. They were down a lot. Okay, if you remember, from their past earnings, AMD was down a lot on their client and gaming segment, but now they're looking like they're up a lot. So they actually turned it around a lot, and they're doing very good things. Their operating margin 21% instead of 8 last year, so very good numbers. And then they're just up a lot. This is a segment that the deal with OpenAI isn't going to help. So the fact that they're actually focusing on this and raising this themselves, I mean, Lisa Su knows what she's doing. Their embedded segment, they just acquired ZT Systems not too long ago. This is going to boost their embedded segment by an insane amount. The compounding annual growth rate on embedded, AI is in the 30 to 40% range. So I think that it's only a matter of time before this company really, the embedded segment's going to look very good here soon too. So I mean, all I can do is smile about this company. This is a company that I got into at a great time, but it's not even about the time. It's just about being in this company. Okay. So the fact that you just have some shares of this company, I think, is the most important thing. I don't even need to go through the financials that much with this one. It's not, I mean, the main thing is their big deal with OpenAI. This is just very impressive that they struck this, that they are actually able to go through with this. It's mainly due to Lisa Su, amazing CEO. We see all the time this company was trading for around $2 for a while. And they're trading for a little bit more now. Okay, so this is very good investment, very, very, very attractive stock. It's obviously on a crazy run, so I get if you're scared to buy it, but at the same time, like I said, stocks that rise a lot. I mean, Google, just another example. This is a stock that's up. You see, if you didn't buy right here at $191, you wouldn't have it at $245. So there's these stocks that make crazy runs. And yeah, they have a decline after sometimes, but a lot of the time they hold it too. Like it looks like Google's gonna hold this high right here. So I'm not worried about AMD, just falling off a cliff. And this is only the beginning. This is only the beginning of what AMD is gonna do. The numbers haven't even came through yet. I think people are it keeps going up every day because people are thinking about it more and more, and they're saying, oh shoot, like AMD is gonna make a lot of money. It's guaranteed. This is a lot of money that's guaranteed in AMD's pocket. They can already see the earnings reports. Okay, AMD's revenue is going to go up this much percent. It's going to go up 100%. It's going to go up 200, 300, 400%. So if their revenue and profits go up 500%, this company is going to be worth, blah, blah, blah. A lot of things are happening. A lot of dominoes are falling in a row. So I really do like AMD right here. I think that you still have to buy it. You can't be scared about buying AMD right here. I might even dollar cost average up, honestly, just because this company is so attractive right now. And yeah, so if you guys did enjoy this video, that's all I have for today. Those are 5 growth stocks that I think you need to buy right now. Very attractively priced. And yeah, so be sure to like the video. Also subscribe to the channel. I really appreciate your guys' support. Making daily videos. I'll be back with another one tomorrow. Thank you for watching. Peace.